Hey there, future Wall Street wizards. You wouldn't jump out of a plane without a parachute, right? So why dive into the stock market without a clue? One of the biggest mistakes I see first-time investors making is, in this video, we're going to walk you through the essential steps to get started with investing the right way. We're talking setting goals, understanding your risk tolerance, and dodging those pesky financial landmines. By the end of this video, you'll be armed with the knowledge you need to start growing your money responsibly. So, buckle up, grab your calculators, and get ready to learn how to invest like a pro, not a chump. Alright folks, let's talk goals. Not the lose 10 pounds by summer kind, but the what do I want my money to do for me kind. Investing without a clear objective is like navigating a maze blindfolded. You might stumble upon something good, but you're more likely to end up face first in a pile of, well, you get the idea. Why are you even thinking about investing? Are you saving for retirement? Trying to buy a house? Knowing what you want to achieve will determine your risk tolerance and investment choices. Think of your investment goals as your financial North Star. They'll keep you on track when the markets get bumpy. Start by thinking about your timeline. Are we talking short-term, like within the next 5 years? Or long-term, like retirement? Get specific. Don't just say, I want to retire comfortably. How much money do you need? The more specific you are, the better equipped you'll be to create a realistic investment plan. And hey, if your goals change along the way, that's totally fine. The important thing is to have a plan and adjust it as needed. Let's talk about risk. When it comes to investing, risk refers to the possibility that you could lose some or even all of your money. The market can be a fickle beast. One minute, you're riding high on gains. The next, you're staring at your portfolio like it personally offended you. Everyone has a different tolerance for risk. Some are financial daredevils, happy to bungee jump off the stock market cliff. Others are cautious cats, preferring to stash their cash in a savings account. How do you figure out where you fall on the risk spectrum? It depends on factors like your age, financial goals, and comfort level with the unknown. Younger investors with a longer time horizon can afford to take on more risk. They have more time to recover from potential losses. Older investors might prefer to play it safer, opting for investments that are less likely to give them a heart attack every time they check their account balance. Your financial goals also play a role. If you're saving for a down payment on a house in the next couple of years, you probably don't want to gamble on speculative stocks. If you're investing for retirement in 30 years, you have more flexibility to ride out market ups and downs. Understanding your risk tolerance is crucial for making investment decisions that align with your financial goals. It keeps you from making rash decisions you might regret later. Let's talk about research. And no, I don't mean blindly following some random dude on Reddit. When I say research, I mean actually taking the time to understand what you're investing in. Investing isn't about following the herd. It's about making informed decisions based on your own goals, risk tolerance, and values. If you're considering investing in individual stocks, start by learning about the company. What do they do? Who are their competitors? What's their financial track record? Don't just rely on one source of information. Read analyst reports, check out industry publications, and maybe even try out the company's products or services yourself. If you're more interested in mutual funds or ETFs, research the fund's holdings, expense ratios, and historical performance. Websites like Morningstar, Investopedia, and the SEC's own site offer a wealth of information for investors of all levels. The important thing is to not just blindly throw your money at something because it sounds good or because everyone else is doing it. Take the time to do your homework, ask questions, and make sure you understand what you're getting yourself into. Remember, you're essentially becoming a part owner of the business, so you might as well act like it. Let's talk about diversification. In the investing world, diversification is all about not putting all your eggs in one basket. Even the most promising investments can go south. If your entire portfolio is riding on one stock, you might want to start practicing your best "I'm temporarily short on cash" smile. Would you rather bet your entire life savings on a single horse race, or spread your bets across multiple horses? Diversification is the way to go. How do you diversify your portfolio? One way is to invest in a variety of asset classes, such as stocks, bonds, real estate, and even commodities or precious metals. Within each asset class, you can further diversify by investing in different sectors or industries. Instead of putting all your stock market money into tech companies, spread it across tech, healthcare, consumer goods, and energy. You can also diversify geographically by investing in companies or funds that operate in different countries or regions. Diversification won't necessarily prevent you from losing money in a downturn, but it can help cushion the blow and smooth out market bumps. Let's talk about emotions. Yes, those pesky little buggers can wreak havoc on even the most well-thought-out investment plans. Investing is a long game, and it comes with its fair share of ups and downs. Our brains aren't always wired to handle those fluctuations rationally. When the market is soaring, we feel invincible. We start making impulsive decisions, buying high on hype. Then, the market takes a dip. Those feelings of euphoria turn to panic and dread. We start questioning every financial decision we've ever made. In our haste to avoid further losses, we often end up selling low, locking in those losses and missing out on potential future gains. How do you avoid falling prey to the emotional roller coaster of investing? Acknowledge that emotions are a natural part of the process. Don't beat yourself up if you feel a surge of panic when the market takes a tumble. It's normal. The key is to not let those emotions dictate your investment decisions. Remember those investment goals you spent all that time defining? Those are your North Star, your guiding light in the stormy seas of the market. Automate your investments as much as possible. Set up automatic deposits into your investment accounts. If you're really struggling to keep your emotions in check, don't be afraid to seek professional help from a financial advisor. Let's talk about fees. Yes, those pesky little charges that can quietly chip away at your returns over time. Every time you invest in a mutual fund, ETF, or through a financial advisor, you're likely paying fees. These fees can come in many forms, such as expense ratios, trading commissions, and account maintenance fees. Some fees are unavoidable, and some are worth paying for quality services and expertise. But the key is to be aware of what you're paying and to minimize those costs wherever possible. When choosing between two similar mutual funds, opt for the one with the lower expense ratio. That seemingly small difference in fees can add up to a significant amount of money over the long term. The same goes for trading commissions. If you're constantly buying and selling stocks, those commissions can eat into your profits. If you're working with a financial advisor, make sure you understand their fee structure. Some advisors charge a flat fee, while others charge a percentage of your assets under management. Managing fees and expenses is like plugging those little leaks in your financial ship. Over time, those small savings can add up to a substantial amount of wealth. Investing can be intimidating, even for the most financially savvy among us. Sometimes we just need someone to hold our hand and tell us it's going to be okay. That's where financial advisors come in. Think of them as your financial Sherpas, guiding you through the treacherous terrain of the market. Not everyone needs a financial advisor. If you're comfortable doing your own research and managing your own investments, more power to you. But for many people, especially those who are new to investing, time-constrained, or simply overwhelmed, a financial advisor can be an invaluable resource. A good advisor can help you define your financial goals, determine your risk tolerance, and choose appropriate investments. They can also help you manage your emotions when the market throws its inevitable curveballs. Finding the right financial advisor is crucial. Look for someone who is a fiduciary, experienced, and trustworthy. Seeking professional advice doesn't mean giving up control of your finances. It's about partnering with an expert who can provide guidance and support. A good advisor can help you make informed decisions that align with your long-term financial well-being. Remember, investing is a journey, and sometimes you need a guide to help you navigate the path. So there you have it, folks, the ultimate checklist for first-time investors. Remember, investing isn't about getting rich quick. It's about making smart, informed decisions that will help you build wealth over time and achieve your financial goals. By setting clear goals, understanding your risk tolerance, doing your research, diversifying your portfolio, keeping your emotions in check, managing those pesky fees, and seeking professional advice when needed, you'll be well on your way to becoming a savvy investor. Check out my next video where I'll dive into the exciting world of index funds, target date funds, and other investment vehicles. Don't forget to hit that subscribe button and leave a comment below. Happy investing!